Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is February 6th. Today we're going to take a look at one out of the consumer discretionary sector, Foot Locker. Let's jump right in. And for those of you who may be stopping by for the first time or who just may have not done so already, if you find any value in the content, if you could hit that thumbs up button down below, hit the subscribe button, join us on this journey to financial freedom, join the Vested Interest community, and hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you think of the video. What do you think of Foot Locker? Is it in your portfolio? For those of you who may be older, I remember going there as a kid, whenever the mall was still a thing. We'd walk around, we'd take a look at the new apparel, the new Air Force Ones or new shoes in general. I don't think that's as big of a deal now. Do they even have malls anymore? I think those are not as big of a deal with everyone doing their shopping online. But Foot Locker is one that I remember. So let's jump back into the video and take a look at it. And thank you to those who have subscribed to the channel and hit that notification bell and hit the thumbs up down below. Really do appreciate it. That really does help out a small YouTube channel like me grow. Now, this is the Vested Interest stock screener. This is how I look at a company on a high level. It's also how I set these videos up. So we're going to run through this criteria, see if it meets the criteria we have set. You can pause it and go through this at your leisure. Now, don't just blindly copy my screener. Make sure that you are setting up your own screener based on your investing criteria and strategy. We all have our own timelines, our own goals that we're trying to achieve. So I'm in my mid-40s. I'm looking more for dividend income so that I can retire and utilize that income to, do some other things investing-wise that I want to do in real estate and some other things, and to live off eventually. You may have a longer time horizon and want a little bit more growth. Or you might be opposed to dividends altogether and just be into growth. It's up to you to set your own criteria, so don't just blindly copy someone else's, especially someone on YouTube that you've never met, you don't know. It could be a complete moron. You have no idea. So let's keep going. Now, back to Foot Locker. If you want to know more about this company, check them out at www.footlocker.com. That's www.footlocker.com. That is where I pulled this information from. That is their homepage. About us, Foot Locker Inc. is a leading footwear and apparel retailer that unlocks the inner sneakerhead in all of us with approximately 2,600 retail stores in 26 countries across North America, Europe, Asia, Australia, and New Zealand, and a franchise store presence in the Middle East and Asia. Foot Locker Inc. has a strong history of sneaker authority that sparks discovery and ignites the power of sneaker culture through its portfolio of brands, including Foot Locker, Kids Foot Locker, Champ Sports, WSS, and Atmos. And here are some of the brands, typical shoe brands: New Balance, Nikes, Air Force Ones, Jordans, Adidas, Hoka. Not sure what this is, UGG. So again, www.footlocker.com. Sneakers and apparel, that's really workout clothes, lounge clothes. That's really what their bread and butter is. Now, I know that they say they have 2,600 retail stores. I think this is part of the problem. They are retail store based. I know they have an online presence, but a lot of these retail stores, brick and mortar stores, are dying. More and more people doing their shopping online, and more companies like Nike allowing you to buy directly from the company rather than go through a company like Foot Locker, saving a little bit of money. So that may be part of their issue. We're going to see they do have issues right now. Now, the reason we are taking a look at them, big issue, down 29.37% on the day. Huge drop on the day. Close out the day at $24.23. We are talking about Foot Locker Inc., ticker FL, out of the consumer discretionary sector. Big drop. You can see, just that's a massive drop for one day. 29.37%. Boy, I feel sorry for the people who have their money in Foot Locker today. Now, 52-week range as low as $14.84, as high as $47. So even with the big drop, they are still floating somewhere between their about midway between their 52-week low and 52-week high. Average volume 3 million. Today's was 33. So just a sell-off, right? Everyone's diving out of this one for whatever reason. That might be the reason. Earnings date March 6th. Must not have been good in the earnings. That would be something to look at here. We're not going to cover the earnings, but it did report today, so that is probably the result of bad earnings. Market cap of 2.282 billion. So a small cap company here. Beta of $1.40 or 1.43. So more volatile than the overall market. Now, they have a high PE for a company like this. This seems pretty high to me, $27.86 per share. Earnings per share, EPS sitting at 87 cents per share. Earnings date, like we said, March 6th, that was today, so I'd look at that. They do not show a forward dividend. I did clip it from stockanalysis.com. They had them at 4.93%, so take that for what it's worth. Ex-dividend date, October 12th. They paid out October 27th. They should have another one coming up here soon, unless they're going to, forego the dividend, which they may. And according to Yahoo Finance, where I pulled this information from, they have a one-year target estimate of $26.93 per share. So they do see some price appreciation on this one, though I'm questioning it. Now, I like to get into statistics, look at dividend yield theory. To do that, we compare its 5-year dividend yield average of 3.89% in this case to its current 4.93%. And according to dividend yield theory, this would be potentially undervalued. Now, I'm going to say something here. I wouldn't look at this. I would not buy that. I would not buy this company personally. The numbers just don't look good. You'll see that here in a minute. Payout ratio at a 183.91%. So they are not doing good on the free cash flow front. And anytime you see a payout ratio that high for a company like this, that tells me they are going to have to take out a significant amount of debt to continue to pay this dividend, or they're going to have to cut the dividend significantly or cut the dividend altogether. So that is not good to see. But if you just went strictly by dividend yield theory, 3.89% compared to its current 4.93%, it would be potentially undervalued, at least according to dividend yield theory. And this is a good, let me stop here and just point this out. That is why you don't take any one metric in isolation. You compare it to all the other information available, and then you make the decision. So dividend yield theory is not the end-all be-all to valuation. There are other valuation metrics. There are other metrics, price to earnings, earnings per share. How is their free cash flow doing? How is their revenue doing? You should be looking at their balance sheet, their income statement, and that is the next step here. We're going to jump into the financials and look at free cash flow. But if you were to go into the financials, a lot of other good information there. Like I said, what does their balance sheet look like? What does their debt to equity ratio look like? What is their revenue doing? Is it growing over time? What are their margins doing? Are they expanding or are they contracting? Are they paying down debt? For our purposes here, we're going to look at free cash flow. We want growing free cash flow over time, because typically if you have growing free cash flow, you have growing dividends. And just the opposite, if you have decreasing free cash flow, the dividend may be in danger of being cut. So we go into back to 2021 here. $903 million in free cash flow. 2022, $457 million. 2023 in the negative. Looks like so far in 2024 in the negative as well. So you can see decreasing free cash flow year over year. Not good. And I don't know why they're repurchasing their own shares. It's actually a bad idea if you have decreasing cash flow and you're over 100% payout ratio. You should not be repurchasing your own shares. You should be paying down debt. But they are repurchasing their own shares. You can take a look at that as well. And the repurchase of shares does not, in my opinion, account. I'd have to do the math, but it does not account for these drops in free cash flow, especially from 2022 on. 2023 in the negative, and again, 2024 so far in the negative. Now, another site that I like is stockanalysis.com. You pick any sites that you like. Just make sure you're looking at more than one so you can back check the information you're getting is accurate and up to date. They have 19 stock analysts that have taken a look at this. They call it a consensus hold. I would say even on this one it would be a sell for me. Again, it's just the numbers don't look good. Low estimate of $11. That would be a 54.83% decrease from where it currently sits. Average estimate of $24.16. That would be a 0.78% decrease from where it currently sits. And only if it happened to hit their high estimate of $43, that would be a 76.59% increase in the stock price. And you could collect that dividend, almost 5% dividend yield if they kept the dividend around. Now, I like to get into statistics here, look at return on equity and return on invested capital, see how financially efficient the company is, how they're doing with reinvesting their capital back into themselves, making acquisitions, building out new facilities, paying down debt, that sort of thing, paying dividends. And return on equity here is sitting at 2.4%. I like 10% or better, so that doesn't meet the metric there. Return on invested capital, again, I like 10% or better, it's sitting at 1.54%, not good. Earnings per share forecasted growth, I like 5% or better. This is sitting at 1.58%, not good. And revenue growth, that says 0.48, but really non-existent. So overall, the numbers on this one just look pretty bad. Again, we're going to go through the dividend history here. Payout ratio above 100%. They say 144.58 here. We saw 180% from Yahoo Finance. Either way, over 100%, not good. Dividend is definitely in danger of being cut. Dividend growth 6.67%. Again, I don't know why they say dividend growth, because they have not grown the dividend since 2022. 40 cents since 2022. And October 2020, they were at 15. April 2021, they were at 20 cents. Jumped it up in October 2021 to 30 cents. Jumped it up in April to 22 cents. April 2022 to 40 cents. And it's been 40 cents ever since April 2022. So don't know why they're listing dividend growth. It looks like they've been stagnant for the last year, at least a little over a year. And with the super high payout ratio, return on equity doesn't look good. Return on invested capital doesn't look good. Earnings per share growth forecasted over the next 5 years doesn't look good. A lot of negatives on this one. I would not be interested in this company personally. Just does not meet the metrics that I'm looking for. But let me know what you think in the comments section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think of Foot Locker. Is it one you're avoiding? It is one I'm avoiding. It's not one that I'm looking to add to my portfolio. Just like I said, the numbers just do not look good. And if you own it, let me know what you're doing with it. Are you looking to sell? Are you going to ride it out? Are you buying more? I do personally read and respond to the comments. I'm always interested in reading your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing during educational and entertainment purposes. Investing involves risk. It money. You should never invest any amount in a comes losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.